Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on the corporate world so you do not have to. And today we are diving into Akari Therapeutics PLC's latest report. And let me tell you, it has some interesting developments, especially around how they are raising business capital. So buckle up, and before we dive in, if you like getting these unfiltered looks at Company Fi. Links, make sure you are subscribed, and for a deeper community connection, check out our Discord link in the description below this filing. Might seem a little dry on the surface because it is a current report of Form 8K, but sometimes these quick updates tell a crucial story about a company's financial health and its immediate plans, like how they are funding their operations. So we are looking at Akari Therapeutics PLC, a company involved in biotechnology, and they have some news about how they are bringing in money through notes, which are essentially loans they take out to fund their business operations. The big news here is about the closing of their August 2025 notes, offering this whole process started back in August 2025, when the company made a deal with some investors to issue unsecured promissory notes. These notes are like IS, where the company promises to pay back the money later, but with a twist, they offered these notes with a 20% original issuance discount. That means for every dollar they promise to pay back, they are actually receiving less than $1 upfront. Think of it like selling something for less than its face value, hoping to make it up on the volume of sales. Akari said they agreed to issue these notes for an aggregate purchase price of $3 million. However, the total amount they promised to pay back the aggregate principal amount is about $3.8 million, this difference. The 3.8 million versus the 3 million is that 20% original issuance discount. We talked about it shows they are essentially borrowing money at a premium to its actual value to get immediate cash. Now, the really important part is that on the 26th of September 2025, they closed the final part of this whole deal. They issued more of these notes for $312,500 in principal value, but they brought in $250,000 for it. This final piece pretty much wraps up the entire August 2025 notes offering. And after this closing, the company has effectively issued about $3.8 million in principal amount of these notes. This means they have successfully raised the funds they aimed for in this financing round. What does this tell us? It means Akari Therapeutics is actively using debt financing to manage its cash flow and fund its operations. This is pretty common for companies, especially those in research and development intensive fields, like biotech, where developing new treatments can be very expensive and take a long time without generating revenue. They might be using this money to fund ongoing research, clinical trials, operational expenses, or even potential acquisitions. Looking at the signature here confirms this is a legitimate corporate filing signed by Torsten Hombeck, the Chief Financial Officer, which is exactly who you would expect to sign off on such financial activities. This shows transparency and adherence to regulatory requirements for companies trading on US exchanges. Now let's put our investor hat on and analyze this. What does this kind of financing mean for Akari Therapeutics PLC? On one hand, it shows they are resourceful enough to secure funding, which is a good sign of operational capability, and investor confidence they are getting the cash they need to keep moving forward with their projects. However, relying on debt financing, particularly with an original issuance discount, can also indicate potential pressure on their cash reserves, or a strategy to maximize immediate liquidity. This 20% discount means they are paying a bit more in the long run for this money. Consider this: if they raised $3 million and have to pay back $3.8 million, that is an extra $800,000 in interest and discount costs over the life of these notes. This is a significant cost that will impact their future profitability. They need to ensure that their business activities generate enough return to comfortably cover these debt obligations without straining their financial health. This strategy is a common balancing act for growth companies. They need capital now to grow, but they have to be mindful of the long-term costs associated with acquiring that capital. The success of this move hinges on how effectively Akari Therapeutics can deploy these funds to achieve its milestones, whether that is bringing a new drug to market or strengthening its research pipeline. Success in those areas will ultimately justify the cost of this financing. In conclusion, Akari Therapeutics PLC has successfully completed a significant debt offering to fuel its operations. While this demonstrates their ability to secure necessary funding, it also comes with a notable cost in the form of a 20% original issuance discount. This move suggests a strategy focused on immediate liquidity, which is crucial for biotech companies, but requires careful management to ensure long-term financial use. Tainability, what are your thoughts on this financing strategy for Akari Therapeutics? Does it signal strength or potential future strain? Let us know in the comments below if you found this breakdown helpful. Please give this video a thumbs up and subscribe for more in-depth corporate analysis. Don't forget to join our Discord community for more discussions. You can find the link in the description. Thanks for watching, and we will see you in the next video.